Hello, we're Group 6 for the Coil project, and this is our presentation for management accounting. So, first of all, I would like to invite my partner, Chi, to present the introduction.
Hi everyone, the President of Marathon Corporation, Max Pickers, call upon management accountant team to help in the future planning for the business. Currently, Marathon Corporation profit have been falling in the recent year. Max wants to discover exactly why it is happening. He has assigned our team clarify the data by streaming figures like project profit, contribution margin, and break-even point. The goal of our team are to provide Marathon Corporation with professional options as to why the company has not been profiting. Secondly, properly show and explain what the business should do in order to keep profit from declining based on the result from Microsoft Excel. And finally is guarantee to have assist Mark Pickers with his collaboration to keep the business running by monitoring and giving feedback on operation. And next, Michael will talk about the analysis.
Yep. Hi everyone. My name's Michael. I'm team lead of Melbourne, and and I will be talking about our analysis and findings, more specifically our cost classification. Um, as you can see with our table here, we have our fixed costs, variable costs, and our mixed costs. Um, with our fixed costs, we have our sales salaries, advertising, miscellaneous selling expense, other salaries, supplies, and our miscellaneous general expense. With our variable costs, we have our direct materials, our direct labor, sales commissions, and advertising. In our mixed costs, we have our other factory overheads. Um, Other factory overheads is the only mixed cost that we've got on our table. Our total costs came at a total of 2,110,000, which came up of 115,000 units. Our variable costs came to a total of $14 per unit. Our fixed costs came at a total of 500,000. Our direct labor had the highest variable costs of $4.7 per unit. Our other factory overhead had the highest fixed costs of 225,000. Next, we have Cam.
Hello, Ming.
Hello everyone. This is Min from Almighty in Melbourne. So I'm gonna take in the next part. So after we did the classification, we're gonna move into the calculating the project net income. So we are assuming that we are selling 115,000 units at the price of $18. So in the end, the total revenue will be 2,070,000 revenue, while the total spend, which come up from the variable cost and the fixed cost, is to 2,110,000. So which will be incur a loss of $40,000 at the end. So the company won't make any profit if we in this situation. And the next thing is we're gonna calculating the contribution margin. So this is the contribution margin table. So the contribution margin is calculated by taking the sale minus the variable cost. It shows the amount of leftover revenue available to cover the fixed cost, which give us 460,000. While the contribution margin per unit is calculated by contribution margin divided by the unit sold, which is $4. In this $4 means that every unit sold by the company, $4 will be added to the contribution margin, and as well as the net income. And the next thing will be the contribution margin ratio, which is 22.22%, which is calculated by taking the contribution margin in dollar, divide the sales revenue. So it shows that 22.22 is the revenue available left to cover the company fixed costs. And the two break-even point in units and in dollar is 125,000 unit and $2,250,000, which means the minimum units sold and the minimum sale revenue to make sure that the company won't make any loss in the future.
Okay, next up, we will have Uyên to present about the target net income.
Hello everybody, my name is Uyên from RMIT Vietnam. So the next question is about the target units of sales that Marathon Corporation should sell to achieve their target income. So regarding the formula of sales quantity to achieve targeted pre-tax profit, we will work in the target income, the total fixed cost, and the contribution margin into the formula to calculate the target sales in units is equal to 162,500 units. That makes the revenue of $2,922,000. Then we have conducted a contribution margin income statement. A contribution margin income statement is a superior form of presentation showing the available amount to cover the fixed cost. Here from the slide we can witness the total revenue, which is total product sales minus the total variable cost from direct materials, labor, sales commissions, advertising, other factory overhead, equals to the contribution margin of $460,000. Then we have witnessed the total fixed cost of $500,000. Therefore, the corporation is making a loss of $40,000, which means the contribution margin cannot cover the total fixed cost. To overcome the situation, we have analyzed some scenarios that my partner Trung will next present to you.
Hello, I am Trung, leader of the Vietnam team, and I'm going to present about the suggestions to improve profitability. So first of all, as we presented, we would have to achieve 162,500 units in order to make a targeted profit. But that is ideal, and what we need is a realistic plan to achieve higher sales. So we have been suggested a number of scenarios. The first scenario is to increase sales salaries by 50%. Now this will raise sales revenue by 30% and total cost by only 25%. So this will result in a new net income of $49,500, which is the most profitable scheme. And the new contribution margin ratio will be 22%, which remains the same, which means that the same amount of total revenue will be, it covers fixed cost. And we have a higher break-even point, meaning that we'll have to make bigger effort in order to not to make a loss. Second scenario, we will have to increase selling price by 15%. Now this will result in lower sales revenue and lower total cost, but the new net income will also be high, $39,350. And we have a higher contribution, meaning that we have more revenue to cover fixed costs, and a lower break-even point means that we can reduce the scale of business while still making a profit. Scenario 3 will have a compound increase in selling price and increase in quality by changing the variable cost, the fixed factory overhead, and the fixed advertising cost. Guys, the screen is, there's something wrong with the screen. something wrong with this computer. It doesn't change the slides. What's going on? Why is it fixed at this one?
Yes, no.
I think it might be internet connection or something.
Yeah.
Yeah, it might be internet connection because the screen doesn't change.
I think you should hide the something underneath.
Right? It's kind of slow. It's unpredictable. Can we do it again? Sorry. Must be something wrong with the connection between the two.